All right, thanks everybody for attending the Federation's Co-op Clinic webinar, Get Your Worker Co-op Ready for Tax Season. My name is Mo Mankling. I'm the Communications Director at the U.S. Federation of Worker Co-ops. And the Co-op Clinic is a program within the Federation where we have experts and advisors who are very experienced with worker cooperatives, a lot of people who have been worker owners and members at cooperatives to present on a particular topic or skill set. And so this is our very first Co-op Clinic webinar for the year. We're very excited about it, and we're very excited to have Bruce Mayer from Wagner CPAs on board to help us get ready for tax season. So the way this will work is that Bruce has a presentation. He'll go on till probably close to around quarter of the hour, and then we'll have time for questions. You can always feel free to use the chat window to ask questions. I'll be keeping track of those, and then we'll make sure that we get to them at the end. So we'll have a good chunk of time for questions at the end, and then Bruce has kindly agreed to stay on for a few extra minutes past the hour if people have additional questions that we weren't able to get to during the minutes. So we're happy to make sure that everyone gets their questions answered. You can also email at usworker.coop if you have questions that come up after this. I will ask that people keep themselves muted unless you are listening to us right now. Unless you're currently asking a question or wanted to like kind of chime in with your questions. So I just went ahead and muted a few people, but and I'll keep track of that as we're going on. But if you do have a question, please feel free to unmute yourself, and we can we'll make sure that those get answered. So with that, I think I'm just going to hand it over to Bruce on behalf of the 200 plus members of the U.S. Worker Co-op Federation. We're really excited to have you, and let's get into it.
Okay. Okay, well, hello, everybody. Thank you for the introduction, Mo. So we're going to talk about taxes for your worker co-op. So this is specifically aimed at worker co-ops. Other kinds of co-ops can gain things from this, but primarily for worker co-ops. So this is the summary. We're going to talk about taxes and filing taxes for your worker co-op, just a little bit about the new tax law, and then income taxes for you. I do have some articles on our blog, wagnercpas.com, that you can follow up. If there isn't enough in the recording here and this slide deck, there's a more narrative form available of at least much of this information. And I'll just stop to say that this is the second year of the new tax law. So last year, the tax law was hurriedly put in place, and things were not really ideal for everybody understanding what it was. But now that things have been here for a year, we have a lot more information, and so I can be a lot more confident about what I'm telling you. And then just one other caveat before we dive in, that this is just about income taxes today. So we're not talking about other kinds of taxes that you might have. There are all kinds of them, sales tax, property tax, registrations, payroll taxes, and so on, that we're not going to get into today. So I'm sure you all know, but just want to remind you, there's lots of other things to pay attention to. And then the first thing to think about income taxes for a co-op is to know what kind of co-op you have. So there are...
First, pop in real quick. We can't see your screen right now.
You can't? Oh dear.
And I've noticed, I think you're getting into the meat of it, so I want to make sure that people can see your slides.
Let's see.
Thanks for bearing with our technical difficulties.
Yep, that's it.
I think you need to just change the display setting, but then you're great.
Let's see. So you can't see it? I'm sorry.
I think if you go to the top where it says display settings and then switch it to the other view, I think then you're good.
Oh, how's that?
Perfect.
Okay. Sorry, everybody. So we're talking about income taxes for co-ops, so you need to know what kind of co-op you have. So the first and most common kind of worker co-op is the cooperative corporation, subchapter T. There are also folks who are taxed as a partnership. This is generally the default taxation for an LLC or an LCA. There are some S corporations, we'll talk just a little bit about them. And then there are a very few other kinds of co-ops, generally not worker co-ops, but I just want to mention tax exempt co-ops, partly because people get some of the terminology confused between kinds of co-ops. So co-op corporation under subchapter T files a form 1120C plus your appropriate state and possibly city and local corporate tax forms. It's due 3.5 months after year end, so that's April 15th. If you're a calendar year, which most of you are, if you're another year end, June year ends have a little bit different due date, 2.5 months after year end. If you are a new co-op, you want to be sure you file that tax return for the first year that you're incorporated or formed. You can easily miss filing that first tax return, and sometimes there are penalties involved, so you want to pay attention to that. And also with a co-op corporation, you can choose a year end other than December. Most people use December. If there's some other time of year that's more convenient to close your books, you certainly can choose initially or move to a different year end. And if you do file late, at least on a federal tax return, if you don't owe any tax, there is no penalty. So that's a good thing. You do need to file that tax return eventually. And if you are ever asked what kind of entity you are, and there isn't a choice about being a co-op corporation is closest to being taxed and treated as a C corporation. So sometimes that's a box you have to check. Nice thing in a co-op, you can pay tax at the co-op level or allocate patronage dividends so that members pay that tax. So you have a choice of being taxed more like a partnership or an S corporation, or more like a regular corporation that gets taxed at the corporation level. So that choice is one of the advantages that co-ops have. If you do decide to pay taxes at the co-op level, the federal tax rate is now a flat 21%. Your state will have income taxes anywhere between 0 and 10%. And then there are some states and cities that have minimum taxes. So sometimes even if you have a loss, you will still be paying something. And one thing to remember is that when the co-op pays tax on income, it adds into the retained earnings, which can also be considered to be the unallocated or permanent reserves of the co-op. So that's something that a lot of folks want to have and that you can't really have in a partnership or an S corporation. So you want to keep that in mind, that when the co-op pays tax on things, it generally is then moved over into the permanent reserve. So if you do decide to do qualified patronage dividends and pay tax at the member level, splitting some of that tax with the co-op or even passing all of it along in some situations, what you're doing, the tax code uses the phrase qualified patronage dividends. So that's a deductible of the co-op, and that's important to remember, different than other kinds of corporations, especially if you're dealing with an accountant who isn't familiar with co-ops. That is the case, that these are deductible to the co-op. When it's deductible depends on whether you're accrual basis or cash basis, and if that doesn't mean anything to you, don't worry about it. It is something you do have to figure out. If you are accrual basis, you can deduct as much, if you allocate the patronage, as much as 8.5 months after your year end. So 2019 year end, if you're an accrual basis co-op corporation, you could pay out or allocate your patronage dividend anytime between now and September 15th and still deducted in 2019. That's one of the biggest tax advantages that a co-op has. If you're cash basis, you can't do that. You have to deduct it in the year you allocate it. So some businesses make a lot more sense to be cash basis if they have a lot of receivables and some other issues. But most co-ops are accrual basis. And then it's important to remember the member has income when it gets allocated to them. So if you are an accrual basis co-op corporation and you do that patronage dividend anytime now till September 15th, your member will pay tax on it in 2020. So next year when they file their 1040 is when they would pay that tax. So very, very important thing to remember. And then if you're going to do patronage dividends, be sure that you have some wording that allows it in your bylaws or operating agreement. There should be something in there that says you can do patronage dividends. It might be more or less detailed based on how things are written. But the main general guideline from the IRS, the phrase is business done with the co-op. So you allocate your profits to your members based on the business done with the co-op or a general measure of how the profits were allocated. So in a worker co-op, that's generally hours. So it's relative hours that everybody worked, and then the percentage of hours that a particular person works will be what gets allocated to them from the profits. And that would be the maximum amount. You can always allocate to people less than that. There is the capability or the possibility of weighting the hours or using a different measure, but hours is the most acceptable. And if you are weighting the amount, you need to be able to justify that some workers are generating more of the profit than others. And generally, the guidance from court case is that you shouldn't be weighting somebody more than about 1.2, maybe 20% higher than somebody else. But that's getting a little bit into the weeds, but just know that generally people use hours and you can use other things. Other kinds of co-ops use other measures of business done with the co-op. So for instance, you're a member of a food co-op, they allocate their patronage dividends to their members based on how much each member buys, so purchases. So we have an example here that'll go on for about 8 slides, just because I wanted to make sure people kind of saw what a summary example might be of how they would do their co-op. So in this case, we're going to call it Co-op Blue. And let's say that for 2019, they had a $20,000 profit. So that's their taxable income before considering patronage dividends. And this takes into account any special tax things you have going on, depreciation methods, if you're adding back for meals or anything like that. But this is the number before any loss carryovers. So you can allocate patronage dividends even when you have a loss carryover. So we have that $20,000 profit, and then we take a look at how much the members work. To simplify this for the presentation, I only have 2 members. Obviously, most co-ops have at least 3 or 4, or a whole lot more than that, but you'll get the idea. So we have member A, 2,000 hours, member B, 1,000 hours. There were non-members, people who were potentially going to become members who worked 1,000 hours. So there's 4,000 hours total. So we take the $20,000 of profit, and then we allocate it to everybody based on the amount of hours they worked. So you can see the calculation here. This slide is a little bit busy, but we have $20,000 of profit. Member A works 2,000 hours. So they worked 2 of the 4,000 hours, so half the hours, and there's a $20,000 profit. So you multiply those 2 together, and they could be allocated $10,000 of that profit. Member B, run through that for 1,000 hours, they could be allocated $5,000 of that profit. The non-members who worked 1,000 hours, they are allocated the $5,000 of that profit. Now, usually, go to the next slide, those non-members are not actually given a patronage dividend. You are actually allowed under the IRS rules to allocate a patronage dividend to a non-member, but most co-ops do not. So in this case, we had $20,000. We can give a maximum of $10,000 to member A, $5,000 to member B, and then there's $5,000 for the non-members, which could be paid to them, generally will be left in the co-op to add to the permanent reserve. So then we make a decision, do we want to pay out the maximum? In this case, let's say we decide that we do. If you decided you didn't, you could pay out in the same proportions less. So you could, for instance, cut that amount in half and pay the member A $5,000 and member B $2,500, and then leave the rest in the co-op and have the co-op pay tax on it. But in this case, we decided we were going to allocate to member A and member B. And the next thing to remember is that you don't have to pay all of it in cash. You can retain as much as 80% of it.
Hey,
So,
Bruce, Bruce, there's a question in the chat about just basically asking you to re-explain a little bit and explain where the $4,000 comes from.
Well, there's 4,000 hours worked, and there's $20,000 of profit. So you take the 4,000 hours and everybody's relative amounts of that and multiply it by the $20,000 of profit to get the allocation to everybody. So the 4,000 hours is the total number of hours that everybody worked. So. And then, as I said, we're allocating a patronage dividend, $15,000 dividend. The non-member part we're going to pay tax on. And of that member portion, we're going to allocate them 20% in cash, which is the minimum amount that we can do under the IRS rule, and then the rest is retained. So once we've done all that, we're allocating in cash $3,000 to the individuals, which we'll go back to that prior slide. You can see 2,000 cash for member A, 2,000 cash for member B, so $3,000. Then as equity, we're allocating 12,000. And then the co-op is going to pay tax on 5,000. And there's just a little calculation there about how much tax the co-op would pay. And the individuals would pay tax on that, the full amount that they were allocated. So that would be, excuse me, they would pay tax on the $15,000. So member A on $10,000 and member B on $5,000. So when they go to report their 1040, that's what they'll have. And then I'll go through how that happens in the next couple of slides. So for Co-op Blue, when they allocate the patronage dividend, they need to issue a notice. When there's only two of you, it's pretty easy to just do that with an email or something like that. When you get bigger, you generally want to formalize it, and I'll go through an example of that. Generally, if you're giving the allocation, you want to mention what the authority is that you're doing it under, generally your bylaws or some other policy that you've adopted. You want to be sure to tell people what the amount of cash and the non-cash is. And you want to make sure that you report all of that on their 1099 PATR, the patronage dividend reporting form, for the calendar year that you allocate and give them the notice. So, so the basic idea here is you just have to tell people that you're giving them a patronage dividend to make it proper. And there's a lot of IRS rules around how that notice is given. Here's an example of that notice of patronage dividends. And so we are issuing this dividend in 2020 based on 2019 taxable income. And this is called a qualified written notice of allocation. If you ever talk to anybody who's gotten into the IRS code, they'll know what that is. And then it just goes through and says, in accordance with our bylaws, section 782, whatever that section is, tells the person what their total patronage dividend is, the cash amount, the non-cash amount, and that all of it will be taxable to them. So those are all important things for everybody to know. You know, that next year you will have some tax to pay. So the next section, that was the example. And again, you will undoubtedly have to go back to that and review those slides if you're trying to apply those that formula into your co-op. But this will be out there, so you can do that. The next section is on co-ops, taxes, partnerships. So again, this is not as common, but there are quite a few co-op partnerships out there. And so I wanted to go through this. They actually have a little bit harder time with some tax issues than a co-op corporation. So you file a Form 1065, which is the federal partnership return, plus a potentially state and city partnership forms. It's due 2.5 months after year end, so that's March 15th. So you don't want to miss that deadline. You can extend it, and you have to be calendar year if you're a partnership. And then be sure to file that first tax return for the year you're formed, because in this case, there are late penalties that can be very significant. I think it's actually $205 per member per month now for up to 12 months. There are some limited exceptions to get out of that penalty, but you know, if you don't meet those exceptions, it's a big penalty, so you want to make sure you are getting that form filed or extended. One thing to remember is that the IRS does not treat these entities as a co-op. As a co-op, they are not under subchapter T, so they are taxed just the same as any other partnership. But you can make them reflect you know, some of the co-op values. But as far as the IRS is concerned, it's only a partnership. Tax is then paid at the individual level. There is no tax paid at the partnership level, in that there is no permanent reserves. There are some fees or taxes that are paid in certain jurisdictions. I list a few here. For most folks around the country, there's no tax due with a partnership tax return at the federal or the state level. So as I mentioned, all income has to be allocated to the members and there are not reserves. And the allocation, which the terminology can be confusing. The partnership tax return, the Form 1065, has a schedule attached to it called the K1. And that goes to each individual partner, and that's what they use to report their income on their personal tax return. So just remember, when somebody says K1, they're referring to the allocation. It's very similar to a 1099, but with more details on it. And it allocates all of the income and reports the guaranteed payments. Guaranteed payments is the same as a salary or wage paid to the partner or owner of a partnership. So in a partnership, you're not getting a Form W-2. So there are pluses and minuses to that. And it's important to remember accrual or cash does not change how the allocation works. The partners always pay tax in the year that the partnership earned the money. So if you have a partnership and it has a profit or a loss for 2019, that gets reported to you and you will report that on your personal Form 1040 for 2019. Your operating agreement, which is the bylaws for a partnership or LLC, should discuss how you're going to allocate profits. In a traditional partnership, it's always allocated based on percentage of ownership. There are exceptions to that, and that's where the flexibility comes in, where a worker co-op can still use hours to allocate profits. There's really no tax code restriction on how you allocate your profits, the weighting or modifications. The only thing is that it needs to reflect an economic reality, which is basically how the profits were earned, and it can't be based on tax avoidance. So as long as that's not the case, which I've never run into that in a partnership co-op, you are good to use hours or some variation on that, and there's no tax code restriction on really how you do that. So we have an example. This one is a little bit shorter because partnerships have a little bit less to worry about than co-op corporations. So this is Co-op Green, and they also had a taxable income for 2019 of $20,000. Again, based on their federal taxable income, taking into account depreciation, any add backs that they might have. But it is, again, there's no taxes taken out, so it's not before taxes or patronage dividends because there aren't any in the partnership. So again, they decide to allocate based on hours. And so we have the same formula, 2,000 hours for member A, 1,000 for member B. So the members work 3,000, the non-members work 1,000. So there's 4,000 total hours worked. But in a partnership, you would not be allowed to allocate any profits to the non-members. So all that profit has to get allocated to the member owners. None of it can stay with the partnership. None of it can go to non-owners. So with a $20,000 profit, member A worked 2,000 hours, member B worked 1,000 hours, so they get allocated the profits 2,000 divided by 3,000, and that 3,000 is the hours worked by the working members. And so it's 2/3, 1/3. And so the non-members don't get any. So if you wanted to allocate something to the non-members, you need to have a separate bonus system that was outside of the partnership profit allocation. So you can see this is different. And if you go back to review this later, you can see that it is a different way to allocate. Most of the co-op partnerships I work with really don't have non-member workers, but a few of them do, especially folks who are coming along to be members eventually. So we have the allocated profits here. Member A, that 13,334, 2/3, and member B, 1/3. And the non-members don't get anything. Those non-members should be either employees, they might be independent contractors getting a 1099. Typically, they would be employees getting a W-2, and they're not allocated any of the profits. And those profits to member A and B get reported on a Form K-1, and they will take that form and use it to fill out their personal Form 1040 individual taxes. One also difference with a co-op is that you can have a lot of profit but not have any cash to distribute, and you still have to pay cash on or pay tax on it. So that is one difference. None of this needs to be paid out to A or B in cash. Typically, you would do that if you had any control over it, but it's not a requirement. So the portions that are retained belong to the individual members. So they would be in the equity account, in separate accounts. And you should have a policy for how long you'll retain this equity and how soon you will pay a former member. So you may need to lengthen that if financial conditions, if the co-op is not liquid enough to pay out a member who's leaving. So it's good to have a policy so that you don't get into a disagreement. I've been part of a couple of dissolving co-ops, and there is certainly a chance for people having disagreements where a couple people are leaving, a couple people are staying. What are the rules on how that gets paid out? It's better to have thought about that ahead of time. So that was it for the partnerships. We will only cover the S corporations very briefly. We are a little more than halfway through. We should end on time here at 1/4 to be able to get to questions. So the S corporation, the rules are here. Again, there's so few of them, I won't go through it in any detail, other than to say that they are taxed in some ways similar to a partnership in that they have to allocate all the profits and losses and all the taxes paid at the individual level. So the owners will get a W-2 because they are considered employees and get wages, but they will also get a K-1 similar to a partnership. The Form 1120S, the federal S Corp return has a K-1. So that's really all we need to talk about here. There's more here. If somebody is in an S corporation, you could go through these slides later and consider that. Most of the time, S corporation isn't a really great fit for a co-op. And then I'll just mention exempt organization. Worker co-ops pretty much never qualify for this. And so that's just something I want to throw out there because I do occasionally run into worker co-ops where people have tried to do this and it hasn't worked. Really, the only kind of co-op that we run into that is successfully an actual recognized exempt organization is housing co-ops, where you can be low income or student housing. So generally want to make sure that, that if you're really going to try an exempt organization, you actually can qualify most of the time. You won't be able to. And there's just a note here about that. And again, one thing about exempt organizations is that they don't have any equity and the members can't get any profit allocation. So something to keep in mind. So we'll talk about the new tax law just very briefly. A couple of highlights. One is that meals that you pay for may be subject to a 50% limitation. So if you pay $20 for a meal, you may only be able to deduct $20 or $10 of that, half of the $20 on your tax return. So you need to make sure you keep track of your meals. There are different kinds of meals. And so there's different categories. You want to keep track of meals when you're traveling, meals when you're having a meeting of your co-op. They may be treated differently for tax purposes. You want to keep track of that. If you have any parking or transit benefit, that is going to be non-deductible. So if you have a leased space and that includes some parking spots that are used for workers and not for clients or customers coming in, that amount will generally be non-deductible. So just pointing that out. Also under the new tax law for depreciation, there's faster write-offs, so there's a lot of flexibility in how fast you write things off so you can decrease your taxable income if you would like to. But the one big thing that we'll talk about, and that's for the next few slides, is about the qualified business income deduction. So that's a tax break for business owners, and that's you. You do own a business, and everybody that we talked about today, except the exempt organizations, qualifies for this. So your 1099 PATR, your profit allocation in your partnership, your profit allocation in your S corp, for all of those, that qualifies. And you want to make sure you take advantage of this. This is a big deal that they put in the tax code, and it wasn't really intended for worker co-ops, certainly, but you are owning a business, and it's certainly allowable. You want to make sure you're taking it. There are extremely large amount of qualification rules, income limitations, and complications. For most of you, none of those will apply. And as I mentioned several times in the upcoming slides, your individual tax preparer or the software that you use, like TurboTax, should highlight when you're falling into one of these potential areas. But for most people, the basic idea, as I say on the slide, is that 20% of your 1099 PATR, your patronage dividend, or your profit allocation will not be subject to income taxes. So you get $1,000 patronage dividend, $200 of it will not be subject to income tax. So that's a good deal. In order to qualify for that, you want to make sure you're paying a fair wage, which most places are paying, some sort of reasonable market wage, so that your 1099 PATR or your profit allocation shouldn't really be more than about a quarter of what you're getting in profits. There can be exceptions to this, but you need to study that. You don't want to get in trouble with the IRS. There's a ton of litigation out there about companies that got into trouble over this. So I just have a caveat here about, this is not individual tax advice. I'm not really much of an individual tax preparer. I know enough about it, but it's not something I love. I love co-ops. So make sure you know that I think this is good advice, but it's a possibility it won't fit you. Patronage dividends, they qualify. I give the section here. If you're working with a tax preparer and they don't believe you, you can cite a code section here. And then I talk a little bit about the limitations. And then a really important thing is that a 1099 PATR, your patronage dividend, should not be subject to SE, which is self-employment tax. That's the tax that partners pay and on all of their profits and their income, and it's 15.2%, so it's a lot. It's the employee and the employer portion of Medicare and Social Security. And there is a long article here, which you can go look at by attorney Greg Wilson, which goes into lots and lots of detail about why patronage dividends should be exempt. So we'll go through briefly how to report this on your personal tax return. You'll likely need to come back to this. And what's coming up here is in a, as I said, a blog post article on our website. So you can get it in a somewhat different form. You may find this easier to read. You may find it easier to read in sentences. So you have two options. Both of these options, you don't want to end up paying self-employment tax. So it's important to make sure when you get all said and done that you're not paying tax more than once and that you aren't paying the self-employment tax. So for the 1099 PATR, the first option, and I think the best one, if you can get your software or you're prepared to do this, is to report it as other income. So that's Schedule 1 of Form 1040. I'm going to give the part in the line, and then how to describe it. 1099 profits from Co-op Blue, and then the employer identification number of Co-op Blue. Reporting it on this line, you will not be on the other income line, shouldn't be subject to self-employment tax. In order to get that 20% tax break I talked about, you also have to report it on Form 8995, which is a brand new form under the new tax law for that qualified business income deduction, QBI. Use the same description, and you may have to override to get it onto Form 8995. I did talk to somebody who was not able to figure out how to do this with TurboTax, and I talked to somebody else who was. So I am not at all a TurboTax expert. So if you can get it to work, great. I think this will not be a problem. So if this doesn't work though, go to option 2, and that's to report your 1099 PATR income on Schedule CEZ, which is the Schedule C for small business that's owned by just you. And again, I give a description of how to report it. And my narrative article gives a little bit more description actually on how to report it, so you might want to go take a look at that. And one important thing to say is if you do report it here, don't take any deductions or mix in any other business. You're basically nullifying your claim that it's not subject to self-employment tax, because if you're actually operating a business, you do potentially have self-employment tax to pay. So when somebody files a Schedule C normally, let's say you're a consultant on your own, you pay that SE tax, but you also qualify for that 20% qualified business income. But usually the 20% qualified business income deduction is going to be less than your self-employment tax. So you don't want to go here. You don't want to go to paying self-employment tax if you can help it. So if you report it on Schedule CEZ, if you have good software like most professionals use, you should be able to mark that Schedule CEZ as not being subject to SE tax. If you can't do that, which is the case in TurboTax, you can go to Schedule SE, which is where this tax is calculated, and enter an adjustment to that form offsetting your income from your 1099 PATR. Again, this is a lot of information. I would suggest going to the blog article when you actually go to work with your return, but I wanted to make sure everybody heard about and at least vaguely understood this. I know my personal rate of retention at a webinar is relatively low, so I understand, but maybe the only thing you remember is look at this again or read the article when you go to do your personal taxes if you're reporting income from patronage dividends. And then that Schedule CEZ will automatically flow to Form 8995 and get you that deduction. So that's the easy part of this option 2. You don't have to worry about that piece of it. You want to make sure that it actually does happen. So there are exceptions. here. And as I said, your software should flag those for you, or your tax preparer should flag them for you. So yeah, you can see. Now, last thing I really want to talk about here today is that if you do get a notice from the IRS saying you should have paid self-employment tax, the first thing to do is not panic. And the second thing to do is to go to this page on the U.S. Federation of Worker Co-ops website. And there is a discussion about this issue, and then there is a template response letter to the IRS. Everybody that I know about, that we know about, who responded to the IRS with this letter had no problems. They had no follow-ups from the IRS and didn't owe any taxes or penalties. So it's unfortunate that it may happen, but it's really not that big a deal. So you just have to make sure that you timely reply to the IRS if they do send you a notice. If you prepare this under option 1, you shouldn't get a notice. If you prepare it under option 2, you might get one. You know, of the people I know who did the equivalent of option 2 for 2018, maybe a third to a half of them got a notice. So you just don't know. So here is that link to the blog post on our website that covers this in more detail. Feel free to take a look at that, copy it, whatever. Now, if you're in a partnership, everything is pretty standard, so you should not have any issues. You do have that self-employment tax to pay, but you know, and most of you who've been doing this for a while understand that. There's just a little explanation here, you know, if you want to go over that. Same sort of thing in an S corporation. The reporting for that 20% QBI will be automatic. And the fact that you're not subject to SE tax on your profit allocation is by statute, so there isn't any big issue there. So we have next, I have my little question mark guy, which I love. So we're all set for today. We're right on time, and I will give it back over to Mo for questions. And as she mentioned, you know, my contact information is here. You know, feel free to shoot me a note. I do get contacted by a lot of worker co-op folks with questions, so sometimes I may be kind of busy to get back to you. If for some reason I lose your email, don't be shy about getting back to you. So, anyway, thank you.
Thanks so much, Bruce. And I will also give a little bit of a shout out to our membership team, who is always really excited to gather these kinds of questions that people are asking and to share those resources. So, you know, for instance, Bruce mentioned that a few people actually did end up sending the letter about the patronage. And so we have been trying to gather, you know, who those people were, what was the letter they sent, like how can we share that information back out to people. So as you're sending notes to Bruce, it's also really helpful to copy us on those so that we can track all that information. Kate Brute, who is also in this webinar right now, does a lot of the hustling to make sure that everybody is as resourced as possible. So I'm going to get into the questions, but I just wanted to throw that shout out to the membership team. The email is membership@usworker.coop. So feel free to ask questions that way too. So I am going to spin through some of these questions. I got all the ones that were posted into the chat, which I imagine actually will take us to time, but let's see how they go. So the first one is the allocation method predetermined by the bylaws, or is it determined on an annual basis by the members?
It should be stated in your bylaws. You can change your mind. The technical IRS rule is that you should have that in your bylaws or in a policy adopted at the beginning of the year where you're going to allocate the profit. So.
And the next one is, when is the 1099 PTR due, and when does it need to be sent out?
It's actually due to the IRS by the end of March. So for 2019, you're not late. Most people would like to get their 1099 PATR earlier than that, but you actually don't have to get them out to people until the end of March.
And a couple people are asking this question about the S Corp. I think you had mentioned that the S Corp was not an ideal entity choice for a co-op, but it has been recommended by some people. We're wondering if you could speak a little bit more towards that.
Sure. It could be a pretty long discussion, so I'll just keep a brief answer. But basically, an S corporation is required to allocate profits based on percentage ownership. So if you have a small group of people and they all work roughly the same amount, it would not be hard to do the profits based on business done with the co-op idea. So everybody's working the same amount. You don't have any non-members. An S corp can be essentially the same as a worker co-op. You could get into more complicated issues if you have non-member workers and differential allocation in your equity through a bonus system. So those all can be done. And I know, for instance, ICA Group really likes S corps. And for some groups, it's essentially the same as a co-op. But I think that it's not something that a lot of worker co-ops would find is really a good co-op form.
Thank you. And I know, Emily, you had a longer question, but you should feel free to email Bruce about that one. Alex is asking, do you recommend that co-ops always give qualified written notice of allocation?
The IRS says that you are required to. I know that co-ops, small co-ops don't always do that, and I think it would be pretty easy if everybody in your co-op is a member of the board of directors to say, they were there when the decision was made, so there's no question. But the IRS says you are supposed to give everybody that written notice.
Quick and easy. Okay. The next question is, this is our first year as a worker co-op after converting an existing business, and we have significant income to manage for taxes. If I'm understanding correctly, we could file our corporate taxes prior to April 15, 2020, and allocate patronage to individual members as late as October 15th, 2020. I would assume that our taxes filed in April would show exaggerated taxable income for the corporation if we don't identify the portion of earnings that are attributable to patronage. Does that mean that we have to determine the aggregate patronage for members prior to April 15th and allocate it to individuals by October? I know that was a mouthful, and that was also Vaughn that asked the question. So I want to invite them to unmute themselves and fill in if I missed anything in that.
Well, I can answer that. I didn't talk about it in the webinar, but you aren't supposed to file your co-op's tax return until you've paid out that patronage dividend. So, and the co-op tax return can easily be extended. And the payment date would actually be September 15th, but your tax return due date would be October 15th. So the idea is that don't file your tax return until you've got your patronage dividend figured out and allocated to everybody. Because of the problem you say. Technically, if you filed your return, you've pretty much told the IRS, if you file it without a patronage dividend on it, you've told the IRS you're not doing one. So if you do one later, you potentially have to amend, or you're creating some other kind of problem.
Great. Yeah. Next question. Can you reiterate or elaborate on the part about LLC partnerships not being allowed to retain? Sure. I missed what it was retained, but I'm willing to bet you know what it was.
Yeah, they don't have permanent reserves or unallocated equity. And the rule in a partnership and the same in an S corporation is that all of the equity has to be in the name of a particular person. So then that's because the individuals all paid tax on it. So you just can't have any equity that belongs to the partnership or to the S corp. And the way that co-ops can deal with that to protect the co-op is if somebody leaves the co-op, you can slowly revolve back their equity if co-op can't afford to do it immediately. So you can sort of have a system that maintains equity for the co-op, even though people leave, but you can't have any that actually belongs to the co-op in a partnership.
Great. Thank you. Next question is, for partnership taxation, what happens if someone is a member for part of the year? Do they still receive a share of the profits, and does it depend on their employment status at the end of the year? For example, if a member retires halfway through the year or is terminated halfway through the year, do they still receive a share of the profits? And can the rules that govern this be written into the operating agreement?
Yeah, the operating agreement should address that. The general rule would be you would prorate the year. So if somebody left in June, they would get a half allocation of the profit. You could actually get into a lot more detail in partnerships. They can be extremely complicated tax-wise. But the general rule would be that you would prorate their ownership and that you should address that in your operating agreement, just so everybody knows, what to expect.
Would the same thing apply if someone were fired mid-year? That would also be prorated?
Yeah, that would be the general rule. Certainly you could have something in your operating agreement that says if somebody, leaves under whatever bad terms or is fired for cause or whatever, that they wouldn't be entitled to an allocation, but the general would be the same as somebody who quits.
Next up is immigration status a factor for S corps?
Yes, because people generally have to be employees, so they need to have an I-9 and all those things. So yeah, partnership is the only place where you really can have a non-citizen owner, and that's well established. You can have an ITIN and be part of a partnership, but it doesn't really work in an S corporation because you have to be an employee.
Gotcha. Thank you. The next question is, how about pre-tax commuter benefits run through paychecks? This is from Rockman. I'm not entirely sure of the full context of that, so if you want to chime in.
Yeah, I looked at that. The question here is about the new rule where parking and transit benefits are not deductible. And the rule on that is, and this I know is true, I believe, in New York City, where companies will have a pre-tax deduction that their members can take to pay for their subway pass. The rule is that the amount of money that's pre-tax has to be non-deductible to the co-op. So if the co-op paid it directly, it would be non-deductible. If the employees get a pre-tax deduction, the co-op can't deduct that portion of that employee's pay. So it's a very unfortunate law, but that's what the law says.
Okay. The next one is there an IRS guidance document related to the 25% limit of patronage as a portion of wages and profits?
No. That is a general guideline that accountants have. It's based on, S corporations get into this litigation a lot. Co-ops haven't really been involved in this, but there is a lot of litigation out there about S corporation owners who are trying to move more of their compensation into the profit allocation, which is not subject to self-employment tax, as opposed to their wages, which are. And so that general 25% rule is something that came out of lots and lots of S corporation litigation. So it is definitely not written down anywhere. And there are some complicated tests about whether somebody is getting fair wages or not. And again, a lot of this S corporation litigation goes into that. So that's a really significant, large topic if you really wanted to get into it.
Do you have any recommendations for co-ops, taxes, partnerships with little to no W-2 income, mostly members, who are running into income limitations for QBI?
Well, that gets into some of the complications of the QBI. So yes, certainly if people had limitations based on their income, you might want to look at how you could restructure your business to make sure you can get that deduction. Again, having W-2 wages for some people would help do that, or potentially switching over, from the partnership to a co-op corporation, would be a way to do that.
And we're getting to the end, and we'll open it up to verbal questions in a moment. So 2 more questions. Is there a written document describing the guidelines for weighting hours differently for the purposes of allocations?
I haven't written anything. There are a couple of court cases out there, generally around sawmills in Oregon, quite a few years ago, like back in the 30s, where there was litigation. The IRS challenged the patronage dividend deduction of some sawmills that were weighting their allocation. And the sawmills were successful in defending that. So you'd have to get into it, and I don't remember the name of the particular cases. They're not too hard to find. But that's really the guidance that people have. And I know there are some articles out there, but I can't think of anything right now.
I'll try to dig that up. I believe I know what you're talking about, and I think that Democracy at Work Institute has track of that information. So I'll try to include that in the follow-up email. Last written question is any part of cooperative corporations' retained earnings potentially untaxed, or is everything held by the business taxed at 21%?
Yeah, everything would be taxed. The only things that aren't taxed is equity contributions that members might make. But if there's any profits, that has to be taxed to the corporation before it goes into the reserves. So yeah, there isn't really any untaxed reserve.
Cool. All right, that is all the written questions, and we're almost at time. So what I think I'll do is I'm going to do a little bit of wrap up, and then we'll consider the webinar portion over. But you're welcome to hang out, and if you have any other questions that maybe haven't come up yet, or want to get an expansion on something that you've seen, we can do that then. So thank you so much, Bruce, for this. This is a really, really rich webinar that I'm sure I'm going to have to watch a bunch of times because a lot of it, frankly, goes over my head. But I'm very happy to have experts like you around to help kind of like demystify some of this stuff. On the Federation front, I have up on the screen some of the other resources that we have available, and to let you all know that, this, as I said, is a co-op clinic webinar that is kind of a feature of our co-op clinic program that offers technical assistance and consulting to worker co-ops and anyone kind of like in the cooperative sector. That's a lot of peer advisors and subject matter experts. So we're excited to talk with anyone and even just kind of help you figure out where to go. So if you need any help, you can reach out to us at usworker.coop/co-op clinic. A couple upcoming events that I'll highlight is that tomorrow we're having we usually have a worker co-op startup webinar on the first Friday of every month, and tomorrow we're going to do it in Spanish. So if you know anyone that would be able to make use of that resource, please make sure to tell them about it. You can find information about that at usworker.coop/calendar. And the next Co-op Clinic webinar is going to be on bylaws, shaping and understanding your worker co-op's governance. And that's going to be hosted by Matt Feinstein, who has been a long time advisor for us back when Co-op Clinic was the Democracy at Work Network, and now with the Co-op Clinic. So we're very excited about that. It's going to be on February 26th. And that's it for the announcements. Everything that you're seeing here and the slide deck and the recording will all be sent to you as you register for the email, or for the webinar. So we'll send all that out to you in the next few days, and thank you so much. And I'm going to scroll back real quick through some of the additional questions. Let me see, I think that there is one more. There's so many thank yous in here. Does anyone want to actually just unmute themselves and ask a question?
I have one. This is Stacy.
Go ahead, Stacey.
I think I know the answer to this, but can I just make sure I know? The 1099 PATR, that's only for a corporation, right? You don't send those out for an LLC or an S Corp.
Right, that's correct.
Great, thanks.
Great. I think that's it. I think we've gotten to all the questions. If anyone else would like to speak up, that you're free to do so. Otherwise, I think that's a wrap.
Thank you, Bruce. You're the best.
I have a question.
Yeah.
Yeah. Can an LLC have a policy of deciding how to divide profits, like as you would a patronage dividends? But can you have a policy that the worker owners can decide from year to year how much to pay out in cash and how much to put into the accounts, or does it have to be like a set thing that applies every year?
Yeah, the amount that you pay out in cash versus non-cash is changed every year. So some co-ops will specify a minimum amount to pay in cash, but the board can decide, how much cash they want to do and move that percentage up and down every year, and that does not have to be in the bylaws or operating agreement.
All right. I think that's it, everyone. Thank you so much again for taking time out of your day to hang with us and learn about taxes for your worker co-op. And I hope to see you at the next co-op clinic webinar.
All right, thank you.
Charlton.
Thanks, Bruce. Thanks, Mo.
Charlton to help her up to Martin tomorrow instead of Friday.